And welcome to this presentation of Screening 2.0, how to take your investing to the next level. Here's an agenda of what we're going to run through today quickly. As I told you in the email, I'm going to tell you something quickly that I found about the free cash flow yield indicator, why you should be careful of that at the moment, how to find quality undervalued companies now, with the US market so overvalued. I'm still finding lots of companies that are really good quality, very undervalued, and have good stock price momentum, but they're not in the US because the markets there seem to be really, really overvalued. I'm going to show you broadly how my portfolio is structured and how I'm thinking about my investing at the moment. And then I'm going to give you largely a few thoughts about how to prepare yourselves for a crash, should there be a market crash. Everybody sees the markets are very high. Maybe they're due for a correction. Who knows? They've been going like unbelievably high for the last period. But let's get stuck in and be careful of the free cash flow yield indicator. Let's just quickly go through how it is calculated. Free cash flow yield is free cash flow divided by enterprise value. And free cash flow is obviously cash from operations minus capital expenditure. But cash from operation also includes working capital changes. So in other words, is the company investing in inventory and accounts receivable, or what changes have occurred? But during the corona lockdown, inventory and accounts receivable ran down substantially. Just think about it. These companies were getting paid. Maybe they didn't produce anymore. They sold less, but they still sold and they weren't producing, so their inventory went down. And also because everybody didn't know what their future was going to look like, they completely stopped capital expenditure. All these three factors, or probably more, led to free cash flow increasing substantially in most of these companies. I'll give you an example of a company we recommended in April in the Quant Value newsletter. It's a German crockery and cutlery manufacturer called Villeroy & Boch. And as you can see at the bottom right of this, just look at the bottom right arrow, you'll see that changes in working capital. There was a little bit of cash generation, investment, a lot of investment, then a little bit of cash generation. But look at the cash generated in 2020 from working capital changes as inventory and accounts receivable went down. I don't show it here, but capital expenditure also went down substantially. And you can clearly see it here. Here's the free cash flow yield, or free cash flow per share divided by share price, 3.6 times, which is obviously extremely low. If you take the 5-year average, it was 14.4. So remember, this number is included in the 5-year average. So this number was probably even higher, say 15 or 17. And then if you look at free cash flow yield, or rather the inverse of it, enterprise value to free cash flow, you'll see latest year 2.4, whereas on average it was 9.5 times. If you exclude that number from the average, probably 12 times. This is one of the factors we look for when looking for undervalued companies in the Quant Value newsletter. Obviously, there's 3 other factors in the QI. We'll get to that later. But the stock, nevertheless performed extremely well since April 2021 when we recommended it. But just be careful if you just use free cash flow yield as a valuation measure, because obviously that's going to turn around in the next year as these companies start producing. Working capital is going to absorb cash. Maybe they'll spend more on capital expenditure and the free cash flow yield will go down substantially. Now let's get to how to find quality undervalued companies now. Because a lot of companies were underperforming substantially during the corona crisis with the lockdowns and whatever, I thought it would be better to start the screening from the point of view of looking for a quality company first, which means removing the worst 50% of companies according to gross margin marks. Gross margin mark is gross profit divided by assets. It's one of the only quality ratios we tested that really worked well. Debt to equity, obviously the old classic one, not to buy too leveraged companies. Free cash flow to debt, obviously this one's going to be a little bit affected by the factors on the free cash flow generation that I mentioned earlier, but a lot of these companies used a lot of this free cash flow they generated to pay down debt, which obviously is a good factor and makes the company a bit more quality worthy, you can say. External finance is another good ratio to be able to. The ratio just shows you, is this company able to finance its asset growth from cash generated by the business, or does it have to go and get external financing like bank debt to finance its asset growth? The studies or the tests we've done, in spite of the academics that developed this ratio, found that this is a very, very strong ratio, even just on its own, to find good companies to invest in. And then we want to screen out value trap companies. Obviously, they're always around, by looking at companies with strong momentum. To do that, we're going to look at companies with an adjusted slope value of greater than 30, or if you prefer price index, take it, greater than a value of 1.5, which means the share price increased about 50% over the past 6 months, as price index 6 months is calculated by the current share price divided by the share price 6 months ago. And then just to get quality companies first, then look for momentum companies to screen out value traps. And of these companies that are remaining, we want to find cheap companies to value cheap companies as defined with QI value. The QI value indicator, just to refresh your memory, consists of EBITDA yield, earnings before interest, depreciation, and amortization, divided by enterprise value. Earnings yield, earnings before interest and taxes, divided by enterprise value, and free cash flow yield as well. It's only one of the 4 factors, as we discussed previously. And then we also have low liquidity, companies that are not as highly traded per year compared to their total market value. And we found that that was also a really valuable ratio to find good quality companies. To give you an idea of what companies are coming up on the screener now. Oh, sorry. First of all, this is more or less just this quick snapshot of what the screen looks like. There's the gross margin Novi marks. We're taking the top 50 companies, getting rid of the bottom 50. Debt to equity, top 50 companies we want in the database or the screen. We want to get rid of the bottom 50. Free cash flow to debt, same story. Get rid of the worst 50% of companies. External finance, get rid of the worst 50% of companies. Keep only the best. I've got a small daily volume indicator, 80,000. That's enough for me to invest my own money. And here you can see the adjusted slope. I entered a number of 30. Click on this little magnifying glass and select greater than. See it's selected there. And then you'll only get companies that with a adjusted slope value greater than 30, and then sort by QI value. Here you can see the companies that the screen came up with yesterday. As you can see, there's a few forest products companies that obviously benefited by that huge spike in lumber prices in North America. They've come back greatly, but these are obviously companies with record profits that you want to avoid. The newsletter subscribers will remember companies like Oriental Watch Company. That one we recommended about, I think it was about a year ago. Anyway, the stock price is up 95%, but the company is still very undervalued. They paid 2 substantial dividends, and at the worst of the financial crisis, this company was already undervalued before that Corona crisis dip in the markets came, and then the company bought back 20% of its stock. So biggest Rolex dealer in Hong Kong, I think probably all of Asia. Really, it seems like a super company that is still undervalued, even though its stock price has gone up 95%. Strabag, that's the Austrian construction company. That one's also in the newsletter. Manito was recommended by the newsletter last month. Here's another lumber company, obviously record profits. Here's another newsletter company. As you can see, some companies with large once-off profits, the old story with the screener. You always get the worst companies or the companies with strong results, and you have to just ignore those ones with record results. Let's look using another composite value indicator, value composite 2. This one has got even more valuation indicators, and it's only got one related to cash flow, which is price to free cash flow. The other ratios that are all included in value composite 2 are price to earnings, EBITDA yield, price to sales, price to book, and shareholder yield. So there's a lot of classic value investment criteria in there. And as you can see, the results don't differ too much from QI value that we used previously. Forest products, there's Oriental Watch again, there's Strabag again. another forest product company. The other ones, here's the one from the newsletter again, Manito, last month. And another forest product once off record profits. So you have to ignore those. But these are basically good quality companies, upward moving share price, and they're still undervalued, which means they're probably still a good investment at the moment because not as expensive as those expensive US companies. How's my portfolio structured at the moment? 43% is in stocks, mainly stocks recommended in the newsletter. Bonds is 12%. I bought some inflation protected ETFs, very straightforward stuff, no funny things. And this bond investment was forced on me a little bit because if I keep too much cash with my two banks that I use as brokers at the moment, they start charging me 0.5% just because of the negative interest rates at the European Central Bank. And then I started looking for a bond alternative, something with a good yield that should be stable, although tobacco stocks also move with the market. I started buying quite 4 or 5 tobacco stocks because I didn't know which one of those would be the winners in the tobacco-less product category. And they have a dividend yield of about 8%. So that's sort of a bond alternative, something stable that I was looking at. And then I've got 33% in cash. And I have no hedging in my portfolio, so no out of the money puts or anything like that. If I get a little bit more uncomfortable, or as I am at the moment a little bit about the US market that just keeps on going higher with the possibility of interest rate increases, then I just increase the cash percentage of my portfolio. No funny hedging or anything in my portfolio. As you can see, it's very, very straightforward and simple. Then my few ideas on how to prepare yourself for a crash. You know, should there be one, but it's beginning to look more and more likely because things can't go on. You know, things, what was that saying? Things that you think can go on forever just cannot. I'm paraphrasing really badly. Anyway, this is a great quote from a great book that I can't recommend more than enough. It's called The Psychology of Money by Morgan Housel. It's a short read. It's basically a summary of a lot of his blog posts that he wrote. But he said that bubbles do their damage when long-term investors playing one game start taking their cues from short-term traders playing another. Basically, he says that, say, for example, you're a value investor buying undervalued companies and values underperformed so long that you get completely fed up and you start buying companies like Tesla and, you know, other high-flying tech stocks. Obviously, traders know what they're doing. They're buying this company on a momentum play, in and out daily. But the long-term investor, first of all, doesn't watch the stock that closely. So he's moving into a completely different game that he doesn't know exactly what to do and he's got no experience from, which probably means he's going to lose a lot of money. Just think about all the value investor guys that started buying internet stocks at the top of the tech bubble just because value was underperforming so badly. And I wonder how much of that is happening at the moment with value fund managers throwing in the towel saying, you know, we've lost so many assets under management, we've got to start buying some tech stocks. And here's a letter. Here's another piece of something out of his book. He said, few things matter more with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are. Think about the trader and the value investor again. The main thing I can recommend is going out of your way to identify what game you're playing. Just be sure as to what kind of investor. I know I'm a value type investor. I like momentum to avoid value traps, but you know, my basic investment strategy is buying undervalued companies, holding them until they become fairly valued or even overvalued, and then moving on to the next undervalued company. And that's why I'm not trading Tesla. I'm not getting interested at Microsoft at a PE of 35. And here are a few other points on how to prepare yourself for a crash. Avoid a permanent loss of capital. I mentioned Microsoft just before with a PE of 35. If you buy Microsoft at a PE of 35 and there is a market crash, and after the market crash, the market comes back to normal and the people start thinking that a normal company growing at a nice attractive rate should have a PE of about 18. If Microsoft goes from a 35 PE to an 18 PE, that's permanent loss of capital. But think about some of the companies invested in it or rather recommended in the newsletter. They have a PE of between 8 and 12. If there's a crash, of course, they'll be pulled down from a 12 PE maybe to an 8, or an 8 will go to a 6. But once the market comes to its senses over time, they'll see that this 12 or an 8 PE was really a good maybe even undervalued, or a fair price for this company. And the company will trade at 8 or 12 times earnings again, which means there's no permanent loss of capital. I can't remember exactly. There was a quote, if you bought Microsoft at the top of the internet bubble, it took something like 20 years for the stock price to get back to that level. Obviously at a much lower PE, but the company grew substantially over that period. Obviously you want to avoid over leveraged junk. And now you can think of Sparks, you can think of, I don't want to say Tesla, but these overvalued companies. And think about all these internet type companies with absolutely no profits, with monster valuations like Uber and things like that. Those are the kind of companies you want to avoid. If you want to trade them, fair enough, but don't bet the house on those companies. And don't get sucked into what's working now. Do not become a trader if you're a long-term investor. We talked about that in the previous quote from Morgan Housel. Have a plan to implement as the markets fall. And this is something where I lost out in the Corona crash, as well as the financial crisis. When the markets lost 20% or 30%, I thought they were going to lose another 20 or another 30%. This largely kept me out of the market until a lot later. And now I've got a bit more of a plan saying that if markets are down 20%, then I'll start investing 10% of that cash percentage that I have. And then if they go down to 30, then I'll buy another 10%. And I know that it's going to be difficult for me, because I always have this tendency to think that the markets will fall further, even after they've fallen 20 or 30%. But I've got a plan now, and I'm going to see if that maybe helps for me. Think about something in terms of what you want to do with your portfolio, how you want to start investing if markets fall. Because remember, when there's a big crash, markets always overreact, and it's usually the best time to invest, because you get companies that are really so cheap, good quality companies as well. And have a plan on how you will manage the pain. I have a friend, we came through 2 crashes already, and there's that great finding by Daniel Kahneman, wrote it about in his book Thinking Fast and Slow, where the pleasure you get from a gain in the stock market is only 1/5 as much as the pain you feel from a loss. And that is really true. I mean, think about how many friends sold out of the market at the bottom at a crash, if you can remember that, just because they were so tired and how can you say, exhausted from looking at that negative number on their brokerage statement all the time. Have somebody that you can talk to that understands these things, that can help you. I mean, you can talk to him, and he can talk to you to keep you in the game, because that's probably the main thing that you want to try and do. That's all for the presentation now. I think it was a little bit shorter than 20 minutes, but if you have any questions, please just write them in the chat box. There was a reader, Michael, that sent me a question already by email. He said that how to avoid buying at the peak with a 6 month momentum indicator being at a high level. Can you apply a strategy that might catch momentum at an earlier stage? That was something that I always thought of as well, but catching momentum at a lower point never helped us at all. If you think about that back test we did with all those European strategies, we looked at the highest momentum companies and then the valuation, and they did extremely well. Also, there was an article that you can find on the website, just search on the website 52-week high. There was a study done by 52-week high and all-time high stocks, what happened afterwards. Generally, as soon as that number was reached, either 52-week high or all-time high, there were some investors that sold them. There was a little bit more selling pressure coming into the market. But generally, stocks moved on from there. I mean, they moved on even higher. So even a 52-week high or all-time high was definitely not a negative indicator. Something that's very, very positive, actually. Let me look at some of the questions in the chat box. Why is momentum, Peter asked, why is momentum a good indicator for avoiding a value trap? Basically, a value trap is a company that is cheap, but cheap for a reason, because the business is falling apart, or it's just not growing at all. And it's very unlikely that these companies will start moving up in their stock price. So if you look for a company with positive momentum, say over 6 months or 12 months on the screener, you can go up to 5 years, then it's very unlikely that a business that is dying is going to go up in stock price. Obviously, you have to watch out for things like GameStop, where there's some sort of other things going on, where those small traders try to shake out those short sellers in GameStop. But generally, if a stock price is moving up, it's moving up for a reason. Think about a small company, even one that is not that widely traded. If there's good news in the company, maybe the employees are talking and saying, man, we're working like donkeys there. We can't produce everything that is coming in orders, and maybe the stock price moves up slowly because there's some insider buying. Not illegal, but they can buy shares when it's not closed periods, and then the stock price goes up. So generally that is reflected in momentum. So momentum is a very, very good indicator. It took me a long time as a value investor to really realize that it is valuable. Then I have a question from Rebecca asking, what about currency hedging? That's a good question, because even in my portfolio, the same as the Quant Value newsletter, there's a lot of companies in Japan. I bought quite a few companies, recommended them in Hong Kong, and they're doing extremely well. The companies there recovered from the problems with Corona. I don't hedge currency in my portfolio. Generally, I found that currencies, the one moves up and the other one moves down, but they wash out against each other. And I've had some losses on stocks, obviously. There was one time that I bought a Japanese company, and even though the company was up 20%, I lost a 16% on the currency, so it was only a small gain. But in general, I don't go to the trouble. My portfolio is also not that large that I can really effectively and at a low cost hedge the currency. If you look on the website, there's an article that I wrote on currency hedging, and there were 2 research papers that I found that basically showed if you want to hedge, you must always hedge, because generally people start hedging after a very strong negative currency movement. And that's obviously the worst time to do it, because there's the currency starts moving in the other way. So if you want to hedge, always hedge. And if you don't want to hedge, stay with that strategy as well, because it's probably going to come out as a wash. Let me then there's a question from Francois. Do you rebalance your portfolio, increase the positions that fell and those that went up? No, I generally don't do that. I have in the past sold undervalued companies too early. So what I generally do now is I move them to a different part of my portfolio where I follow a strict or a bit stricter trailing stop loss. This allows me to let companies that have picked up momentum, let them run a lot higher, because generally what I found is I sold out when a cheap company went to fair value, and generally once they start moving up like that, they even go to overvalued in terms of my valuation numbers, and I always missed that last part of the momentum. So I generally just keep them. I don't rebalance inside of my portfolio if companies have gone up or down. I do use a trailing stop loss, though. The trailing stop loss is also explained. I think the article in the website is called something about stop losses that nobody wants to believe. Then I have a question about from Kaido. What about moving averages to get back into the market after a crash? I recall buying the dip is not a good strategy. There was an article that I think even this month there's an article coming in. There's like a little reading section in the Quant Value newsletter, and it talks about buying the dip is not a good strategy. But I think he tested buying the dip if you only buy when the market dips. For the newsletter, we use a 200-day moving average that we look at once a month on the main markets, on the S&P 500, on the stock 600 for Europe, on the Japanese market. And if the market is below the 200-day moving average, then we stop buying in those countries. There was a study by Mebane Faber where he talked about tactical asset allocation, and he found that that was a very, very effective indicator. He did, however, mention that he doesn't look at it every day, just like we do for the newsletter. We look at it once a month, because otherwise there's just too much noise, and you will generally trade too much. So for the newsletter, we don't recommend new companies if the market is below the 200-day moving average, because the most volatility is there as well. That's what McBain and Faber found as well. And stocks, the most volatility on the downside, in other words, negative movements. And we start recommending companies again when the market is above the 200-day moving average. Let me see, there's a question from Jan. How do you, in your opinion, best identify sector rotation, i.e. out of tech into materials, etc.? Jan, I don't look at that at all. I just look at what companies are cheap on the screener, cheapest on the screener, and I start buying them. Obviously, I generally keep in mind that I don't want to put all of my money into lumber stocks, for example, just say, you know, that they're all coming in cheap on the screener. So I don't buy too many companies in one sector, but that's also the other reason why I generally buy a few companies every month, just like we recommend in the newsletter, because each month, you know, if there was something that maybe a lot of oil service companies were cheap this month, then we'll pick up one or two maybe in the newsletter, but we won't pick up 6 oil service companies. And the next month, because of momentum, or maybe there were quarterly reports, a whole group of other companies will be cheap. And generally, it won't be the same ones that came up in the previous time or the previous quarter in the screener. And that generally keeps me out of any specific sector, but I don't have a sector rotation idea or strategy at all. I know there was that one, I think it was Merrill Lynch. There's a wheel or something that they put together saying if you're in what part of the economy, if the economy is just recovering, if it's at the top, then you generally move from this sector to the other one, but it's not something that I look at. Then there's a question from Martin. Do you backtest results for the quality screener you showed before? No, Martin, we haven't backtested that specifically, but you can easily do that if you want to. You can just use the historical screener in the screener if you wanted to test it, and then you can completely customize it as to exactly how you want to do it. But I know that we used this exact screen to start buying companies after the Corona crash. And that portfolio, I think we recommended 26 companies, and after a year, the average return was 61% of all those companies. And then we have a question here from, I hope I'm saying it correctly, Heil. He asked, why did you not mention the Petrovsky F-score? That's a very good question, Suhail, because as you know, I love the Petrovsky F-score. It's a great one. I just generally avoid companies with a Petrovsky F-score under 5. So I don't necessarily buy the best as Petrovsky specified, you know, the 9 and the 8 companies. Petrovsky F-score goes from 0 to 9. 9 is the best companies, quality companies, and 0 is the worst. I just generally look that I screen out the bottom 50% of companies by not really, I don't buy companies with a Petrovsky F-score of less than 5. John mentions that, have I measured the performance of my portfolio relatively to the benchmarks? John, I do that every now and then, but because I've held so much cash, generally the performance is worse. But that doesn't mean that I'm happy or unhappy with the performance. I'm very happy with the performance because of the level of risk that I'm taking. For example, this year, even though I'm 33% in cash, I think my portfolio is up about between 18 and 20%. So that I'm very happy with. Last year, I was probably up only 6%. But, you know, compare that to the S&P, it doesn't sound that good, but I'm very happy with that performance because I sleep very nicely with a 30% of cash that I've got in the portfolio, and it was even higher in the middle of last year. I think it went up to 40 or 47%. And then there's another question by Suhail. He said, also, what about companies that are cheap but are now way above the 200 daily moving average? Right? Are now way above. So, and if I understand your question, you're asking about what about companies that are cheap but above the 200-day moving average? So I wouldn't avoid those companies at all. I just say I stop buying generally in the US market if the US market is below the 200-day moving average. So then I won't look for, companies in North America. But, say for example in Europe, if the stock 600 is still above its 200-day moving average, then I'll still look for for companies in Europe, or in Japan. Then for that matter, if the Japanese market is above its 200-day moving average. I think that's about all the questions there is. Has anybody got another? Oh, there's one by David. David asks, if he outlives me, who will look after the screener and the newsletter when my time on Earth has come to an end? David, I'm only 54 at the moment and quite fit and healthy. I've also been vaccinated, so I think it's very unlikely that anything will happen to me. I'll keep on writing the newsletter as long as I possibly can, and I'm fit and mentally healthy to do it, because I just love doing it. It's basically the reflection of the best strategy I use in my own portfolio. And, if I do the work for myself or I do it for the newsletter, it's basically the same thing. So I plan on doing it for a very long time still. Thanks for the question, though. Anybody else? Has anybody else got a question? Okay, everybody, thank you very, very much for the time and for the great questions. I hope I've given you a few good ideas. And as always, if you have any other questions, just use the Get Help little box on the website. I'll be more than happy to answer any questions and help you with a screener or with a newsletter if you've got any questions. Also, if you look in the box, there's a lot of questions, frequently asked questions that I've answered there with my really best answered. Sorry, here's another question from David. Minimum number of stocks in portfolio for optimal diversification benefit. David, that's a tough one to answer. A lot of value investors say you must put a lot of money in your best ideas. I've just learned that even though I think something is my best idea, it never turned out to be my best idea. My best idea was sometimes the companies that I thought would definitely not do well, but I bought them anyway, made the position far too small and didn't profit on that too much. Now I just do the same as I do in the newsletter. 2% of every idea I stick into each company and I just let them run. As I mentioned with that momentum strategy that I have, if something goes from cheap to fairly valued, I don't sell it anymore. I keep the momentum on it and then sell it with a trailing stop loss. So I generally have a rule 2 or 3%, but I stick to that for companies. And 50 stocks, if you don't do a lot of research, that sounds fine. Yeah, 2%, that's fine, because if something is on the screen and you bought it and it shouldn't have been there, then it's not going to do too much damage to your portfolio. If generally you're following a strategy that's sound, you'll choose more good companies than what you'll choose bad ones. Maybe have something like a stop loss strategy where you can throw out companies that are really falling, Thank you, everybody. Thanks for the great questions. And as I said, if you have anything, just contact me through the website.